Hi, we will be presenting on how to save and invest for retirement. This is Group 17 with Zoe Chan, Xing Chen, Joe Liang, and Stephen Lin.
Welcome to Stony Finance Lab channel.
The keywords for this presentation are stocks, ETFs, real estate, IRAs, and 401k. Our presentation framework includes what is retirement, retirement plans, compound interest, investments, analysis, and potential mistakes to avoid. So, what is retirement and are people prepared for it? Retirement is when one chooses to permanently leave the workforce behind. According to a study by the Boston College Center for Retirement Research's National Retirement Risk Index, 50% of American households are actually in danger of lacking sufficient funds to continue their standard of living once they stop working. This was before COVID, and now it actually rose to 55%. According to Yahoo Money, 1 in 3 Americans have no retirement savings, and those who actually do save are not saving enough. Planning your retirement. It's actually never too early to start and save, so you should probably start thinking of a retirement plan after this presentation. Some perspectives to consider is your current age, when you plan to retire, all your income sources, current and projected expenses, how much can you actually afford to set aside for retirement, where do you plan to live after you retire, and your lifestyle, any current savings accounts or retirement plans, and health history of yourself and your family, which helps to determine health coverage in the future.
There are three common types of retirement plans. The first one is traditional IRA, where you can contribute and accumulate money that will be tax deferred upon withdrawal after retirement. The tax of withdrawal based on the owner's salary income, and for 2021, the contribution limit is $6,000 for those who are under the age of 50 and $7,000 for those who are over the age of 50. And penalty-free withdrawals begin at the age of 59 and a half. The second one is Roth IRA, where money contributed is not taxed and future withdrawals are tax-free. 2021 contribution limit is $6,000 a year for those under the age of 50 and $7,000 for those over the age of 50. And penalty and tax-free withdrawals begin at the age of 59 and a half. And the third one is 401k, which is a company-sponsored retirement account. The contributions can be made through automatic payroll withholding, and employers can match some or all contributions. And there is two basic types of 401ks. There are the traditional and Roth 401k. And it's basically the same concept as the traditional IRA and the Roth IRA, where the traditional 401k is income tax for the year, which is lowered, but withdrawals are taxed. For the Roth 401k, contributions are made post-tax, but withdrawals are tax-free, and penalty-free withdrawals begin at the age of 59 and a half. Starting early. Saving early gives you more flexibility and more opportunities to retire. You should be aware of the power of compound interest, the process by which a sum of money grows exponentially due to reinvesting the interest earned from your initial savings. If one has access to an employer-based retirement plan, you should take advantage of the employer's matching contributions if they offer it and max it out every year. You should also be aware of tax breaks, which is a reduction of a taxpayer's total tax liability. There are tax deduction, which is reducing the amount of gross income that is subject to taxes. There is also tax credit, offsets the taxpayer's liability on a dollar-for-dollar basis, and tax exemption, which shields a portion of the income from taxation. In a retirement fund, the investment grows tax-free until you withdraw it at retirement.
By the 50-30-20 rule of thumb, you should spend 50% of your income on monthly expenses and needs, 30% on luxuries, and save at least 20% of your income.
An example of compound interest. Say you invest $10,000 in a safe long-term bond that earns 3% interest per year, and at the end of the first year, your investment will grow by $300, which is 3% of $10,000, so you will now have $10,300. However, the next year you'll gain 3% of $10,300, which means that your investments will grow by $309, which is a little more than the previous year. And if it happens over the course of 10 years, this will be the projected balance, and by the end of year 10, you will earn around $13,000. And this is the balance after 10 years, assuming that the interest rate stays the same and you do not make any additional contributions. And it is highly recommended that you make annual additional contributions to maximize your growth. So you decide to start a retirement plan. What should you invest in? There are two funds you should invest in, which is ETFs and index funds. So what are ETFs? It's an exchange-traded fund that have basket of securities that trade on an exchange just like a stock. Their share prices fluctuate based on ETF buying and selling behavior and include stocks, commodities, and bonds. And they offer low expense ratios and fewer broker commissions than buying the stock individually. Some examples include ARK, VU, and IVV. For index funds, it's a portfolio of stocks or bonds designed to mimic the composition and performance of the financial market index, DJA, and the S&P 500. They have lower expenses and fees than actively managed funds and is a passive investment strategy. Some examples include SPY, SVSPX, and SWPPX.
So how do you start investing? In regards to stocks, you want to buy and hold Vanguard 500 ETC, also denoted as the ticker symbol VU. It mirrors S&P 500 index and contains stocks from 500 of the largest US traded companies. It's a passive investment strategy, so you want to buy when you turn 18 and sell when you hit the retirement age of 65. If you look at the figure below, you can see that the number of periods is 47, the starting amount is $1,400, the interest rate is 15%, and the periodic deposit is $2,400. After a 47-year period after your initial investment, you can see that the future value is $12,381,889.03. In regards to real estate, you want to buy and hold real estate property, which means buying homes, buildings, properties at a very young age, and then renting the property out to cash in on appreciation and cash flow. There are three very popular ways of making money off real estate. The first one is called fix and flip. It is the business of finding properties that need work, doing the repairs, and reselling them at top price for a profit. The second way is called house hacking, which is living in a home that also produces income, for example, a duplex, triplex, fourplex, or a house with extra rental space like a basement or spare bedroom. By renting out part of your residence, you can reduce your total housing costs. The last method is called the BRRRR method, which stands for buy, remodel, rent, refinance, and repeat. You look for fixer-upper properties that you can buy below their full value, use short-term cash or financing to buy the property, then after it's fixed and stabilized, refinance with a long-term mortgage. So now we'll talk about the analysis of risk and return. In regards to stocks, VU averages around 15% return per year since its inception. It has very low maintenance, so you buy and hold or buy and continue to buy. It's relatively low short-term risk as long as the market stays afloat. For example, if you invest $1,400 right now and add an additional $200 per month with an average rate of return of 15%, assuming you start your investment at 18, by age 65 you can amass an approximate wealth equating to $12,382,000. There is a potential risk. Huge market correction or crash can lead to investors pulling their funds out. However, this would be a huge mistake as you can lower your average cost over the span of many years. This decreases tax liabilities and reduces the stress of timing the bottom to buy back in. In Figure 2, you can see the yearly investment returns of VU over the past 10 years. If you take the average of the total return percentages of VU, the average annual return is 15%. For analysis of real estate provides more predictable returns than stocks and bonds. It provides a hedge against inflation and can be used as collateral for further investments. For example, you purchased a rental unit and paid $100,000 in cash for the property. Your closing cost was $1,000 and the remodeling cost was $9,000. Your total investment is $110,000. You collect $1,000 in rent every month. This means in a year you will collect $12,000. Your utility expenses, taxes, and insurance total to $2,400 per year. This makes your total annual return $9,600, which is 8.7% return on your investment. Now we'll talk about the average annual home value increase. The average national American home value appreciation rate is 3.5 to 3.8%. If you purchase a rental property worth $100,000 at 18 and hold for 47 years until retirement, at the age of 65, your home value would have increased 5 times in value. You can see in Figure 3 after all the values have been inputted that the final value of your home after your initial investment of $100,000 would be $503,728.40.
Here are some principles for success. You should hold no matter what and do not sell. You should max out your IRA for the year, which is usually $6,000, which amounts to $500 per month. You should not take out profits before the retirement age of 62 as to maximize growth and profit, and you should also hold a diverse portfolio. Some potential mistakes to avoid are to avoid panic selling any shares. In the long run, averaging down will actually be more beneficial in terms of holding shares. You should also avoid over leveraging if you are trading with margin or leverage. Using margin and leverage oftentimes lead to investors taking on debt when the market goes against their position. You should avoid a portfolio that requires active management if you're passively investing. Avoid purchasing rental properties solely based on anticipated appreciation because appreciation rates are not always consistent, and at times, investors may need to sell their property early. You should avoid purchasing too many properties as they do take time and manpower to manage.
So here's just a quick summary of our presentation. You want to start planning your retirement early. There are investment vehicles that you should look into, for example, stocks and bonds, real estate, ETFs, and index funds. You also want to familiarize yourself with the retirement plans, so the traditional and Roth IRAs and also the 401k. Also keep in mind that compound interest is your friend. Here are some wise words from the Wizard of Omaha, also known as Warren Buffett. Successful investing takes time, discipline, and patience.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.